Okay, we are jumping straight into Golar LNG today, looking at their latest Q3 2025 results.
Yeah, and it's a bit of a strange one on the surface, isn't it?
Totally. You see that headline revenue miss, but then boom, the stock actually climbs almost 3% pre-market.
It's that classic paradox. Seems like investors, well, they barely blinked at the small Q3 miss.
They're looking past it.
Completely. It's all about the huge future cash flows Golar has locked in. That's what we need to unpack today.
Right. How they plan to basically quadruple the business by, what, 2028?
Exactly. That's the big story.
Okay, so let's quickly hit those Q3 numbers first. Total operating revenue.
Came in at $123 million. The forecast was $124.67 million. So yeah, a miss, but only by about 1.3%. Pretty small.
Tiny, really. And underneath that, the important stuff.
Looked pretty strong, actually. Adjusted EBITDA was $83 million for the quarter. Net income, $46 million.
And their cash position, still solid.
Very solid. $1 billion in total cash. So like you said, the company's healthy, running well. That revenue figure was kind of noise, really.
And the market definitely treated it that way. They didn't just ignore it. They sort of celebrated almost.
Well, yeah, look at the immediate actions. They declared the dividend, $0.25 per share, and approved a new $150 million share buyback.
Which tells you management thinks the shares are cheap, right? Even now.
Precisely. They've returned, what, over $800 million to shareholders in the last 5 years. So continuing the buyback shows they think reinvesting in their own growth is the best bet.
Because that growth is becoming so visible now.
Exactly. That's the foundation. Golar's moving from being, a developer risking capital to more of an infrastructure play, just collecting cash.
Supported by that massive backlog number. What was it again?
Around $17 billion in Adjusted EBITDA backlog.
$17 billion.
Yeah, locked in, mostly 20-year deals. And listen, that number, it doesn't even count potential upside from commodity prices.
Right, we need to talk about that later.
Yep.
But that $17 billion figure, it just changes everything, doesn't it? The risk profile.
Fundamentally. So how did they build that? It comes down to their floating LNG units, the FLNGs. 3 of them are key right now.
Okay, let's break those down. Start with the first one. FLNG Hilli, the original.
Hilli is just, well, Mr. Reliable. It's maintained 100% economic uptime since 2018.
Which is kind of incredible in this industry, isn't it?
It really is a huge achievement. In Q3, it brought in $51 million in Adjusted EBITDA. But the big news for Hilli is its future.
That's the move to Argentina.
Exactly. It's got a new 20-year charter lined up with CESA down there. They're doing upgrades, life extension work now, secured with Citrium in Singapore.
And when does that new charter kick in?
Expected second half of 2027. And that single deal adds another $285 million in annual Adjusted EBITDA, locked in for 2 decades.
Okay, that's stability defined. Now, unit number 2. FLNG Gimme. That one just started up, right?
Yeah, mid-June 2025. It's on a 20-year contract, too, for BP, offshore Mauritania and Senegal.
So Q3 was its first proper full quarter. How'd it do?
It contributed $48 million in Adjusted EBITDA. That's Golar's 70% share. But the interesting thing, the sources really highlighted this.
Yeah.
It's already performing better than expected sometimes. Daily production is often going above its base capacity.
Really? So soon. They're already finding ways to squeeze more out.
Looks like it. Management said they're working with the GTA project partners on, quote, debottlenecking.
Just finding efficiencies in the system.
Exactly. Getting more gas through the pipes, basically. On an asset that's barely 6 months old operationally, it says a lot about the tech and the team.
Definitely. Okay, that brings us to number 3, the MKII FLNG. This one secures the trifecta, right?
It does. They hit FID final investment decision in Q3. All conditions met for another 20-year charter, also with CESA in Argentina.
And hitting FID, what does that mean financially immediately?
It means, boom, another $8 billion added straight to that Adjusted EBITDA backlog.
$8 billion just from that one decision.
Yeah. Guaranteeing $400 million in annual Adjusted EBITDA once it's up and running. And it's on track for Q4 2027 delivery.
Now, this is a huge project, $2.2 billion conversion cost. How are they managing that spend?
Good question. So far, they've spent $1 billion, and importantly, it's all been equity funded.
Ah, okay. So no debt on it yet.
Not yet. That's deliberate. It sets them up perfectly to bring in attractive debt later, once the unit's fully contracted and de-risked. Lets them recycle that capital for the next one.
Smart financing.
Yeah.
And all this contracted revenue, these locked-in assets, it leads straight to that, well, explosive guidance from the CEO.
Carl Fredrik Staubo, yeah. He said Adjusted EBITDA is set to quadruple between now and 2028.
Quadruple. Going from what, around $221 million now, LTM?
Has an expected run rate of $800 million once Hilli, Gimi, and MKII are all operating.
That's why the market didn't care about the Q3 miss.
Exactly. You've got this clear, predictable 3-year path to multiplying cash flow based on fixed contracts. They even gave specific near-term forecasts.
Right. Q4 25 expected around $121 million revenue.
$121.11 million, yeah. And $125 million for Q1 26. The growth curve is mapped out.
But they're not stopping at 3 units, are they? They're already moving on FLNG number 4.
Aggressively. Following that same playbook that worked for MKII. Ordering key parts early.
Speculative ordering, they call it.
Yeah, securing the long lead items, the LLIs, the really expensive, hard-to-get components before they even have a charter signed for the unit.
Locks in price and delivery slots.
Exactly. And they've just approved ordering the LLIs for number 4 in Q4 2025. Committing capital now to keep the momentum going.
Okay, and here's where it got really interesting in the sources. The competition for those LLIs, things like gas turbines. It's not just other energy projects.
No. This was surprising. The main driver, the main pressure on delivery and price, it's the AI data center boom happening in the U.S.
You're kidding. AI is competing for LNG parts.
It sounds wild, but yeah. Think about the massive power needs of these new AI data centers. They need reliable power, often gas turbines.
So Google, Meta, Amazon,
Yep.
they're ordering the same kind of kit.
Essentially, yes. The sheer volume is sucking up global manufacturing capacity for the specialized equipment. That puts huge pressure on timelines and costs for someone like Golar trying to build their next FLNG.
So getting those orders in now isn't just planning ahead, it's almost defensive. Trying to secure a spot before the tech giants grab everything.
That's pretty much it. They're using their existing relationships with suppliers to lock things down, which makes the design choice for FLNG number 4 really critical too.
What are the options there?
3 main ones. The Mark I, smaller, proven design, maybe for West Africa. The Mark II, basically a repeat of the one they're building now, more versatile. Or the Mark III, a brand new, bigger design, up to 5.4 millitepa capacity.
But that one takes longer to build.
Yeah, Mark III would be like 48 months. Longer lead time, but biggest capacity.
Okay, choices to make. But regardless, committing capital now, potentially billions down the line.
Yeah.
How are they lining up the financing for all this growth?
It's all about that capital recycling strategy. Their policy is only one unchartered FLNG at a time, max. So right now, they're finalizing a new $1.2 billion bank facility for the Gimi unit.
Using the now operational Gimi as collateral.
Exactly. It's contracted, generating cash flow so they can leverage it. They expect that deal to close this quarter, Q4 25.
And how does that help fund number 4?
It frees up cash. That refinancing is expected to release about $400 million in liquidity, money they can then plow into the early work for FLNG number 4.
Very neat. Using the certainty of one project to fund the start of the next, do they see similar potential for Hilli and MKII eventually?
Oh, yeah. Management reckons optimizing Hilli's debt plus putting new financing on the currently equity-funded MKII once it's running. That could potentially raise up to $3 billion in fresh capital altogether.
A $3 billion war chest for future growth, basically, without messing up their debt ratios too much.
That's the plan, leveraging the certainty they've built.
Okay, let's pivot slightly. A bit we skipped earlier, the commodity upside. That's not in the $17 billion backlog figure, right?
Correct. This is the potential cream on top, especially relevant for those CESA charters in Argentina.
And the scale of that upside, how significant could it be?
Potentially very significant. The metric they gave is quite something.
Yeah.
For every $1 per MMBtu that LNG prices, FOB, go above $8, it adds about $100 million per year in extra EBITDA.
Wow. So if prices spike to, say, 10 MMBtu, that's an extra $200 million a year just flowing straight to the bottom line from those contracts.
Pretty much above that $8 baseline, that's the kind of uncapped potential that gets investors excited, way more than a tiny quarterly revenue miss.
Makes sense. And Golar's basic pitch is that their FLNG model is just the best way to monetize gas these days.
That's their view. Cheapest, quickest, most efficient. They argue they can often get the gas cheaper than, say, U.S. producers and save on shipping by being right there near the resource in the market.
Okay, it sounds incredibly positive. But there have to be risks acknowledged, surely, especially operating in places like West Africa, South America.
Absolutely. Geopolitical risk is always there, market volatility too. And just the basic execution risk building these massive, complex units on time and budget is never guaranteed.
Sure.
Although they did point out that for the Argentina deals, the financial structure is protected by something called the RUGI framework.
RIGI, remind us what that is.
It's Argentina's new setup for big infrastructure investments, designed to give investors significant tax breaks, legal certainty, fiscal stability.
So guarantees the rules won't suddenly change halfway through a 20-year contract.
That's the idea. It's meant to mitigate a lot of that specific country risk for huge projects like these.
Okay, so wrapping this up, we dove into Golar LNG, found a company that's, well, executing really well on a clear plan.
Yeah, shifting into this major growth phase, all backed by that huge locked-in $17 billion backlog.
The message seems to be, forget the small Q3 miss. Look at the guaranteed trajectory. Quadrupling EBITDA by 2028.
But that trajectory depends entirely on them being able to keep building these new FLNG units. Which brings us back to that really surprising competition we talked about.
The AI data centers needing the same parts.
Exactly. We heard today the AI boom is directly competing for critical long-lead items like gas turbines needed for energy projects. So here's something for you to think about. If demand from the tech sector keeps exploding like this, gobbling up manufacturing capacity, how are traditional energy players, even ones as focused as Golar, going to manage the increasing delays and costs just to build the infrastructure they've already planned?
Could Silicon Valley accidentally put the brakes on global energy expansion?
It's a fascinating question. That competition might just be the biggest, most unexpected challenge they face in the next few years.